anytime we are looking at any symbol, an index, an ETF, a stock, futures contract at new highs like the NASDAQ did, it's never bearish, gang. It's never bearish. So as we end 2023, let's remember a few things. I think a lot of folks learned a lot about the difference between the Santa rally and the window dressing part of it. Although Santa rally is something everyone likes to say. I think it's just because it sounds so darn cute. But the fact is, the window dressing in December, here's December, is significant. I mean, we've gone from 15,000, 7 and change, 15,800 to 17,000. That's a very bullish month. And to reduce window dressing to the last handful of days of the year is just really myopic. These are not in any way indicative of any change in the trend or any change in the momentum. It's not even touching the daily price movement range like we did back on the 20th, which was the last buy that we set up for the Qs. I'm going to presume overall more strength, right? So let's keep that in mind, but start with some more detail. First of all, 3 big things as far as New Year's trading resolutions or just my game plan for 2024. Bigger picture, gang. Focus on account growth metrics. What does that mean? Account growth, right? Not gain per trade, but gain in my account. Did that trade create a needle-moving event in my account? It could be negative or it could be positive. When we set up our risk, we're not talking about risk to premium alone. We set the trade up knowing what the likely risk to the account is, right? Account growth metrics. Look, gang, professional traders, smart traders, forget professional, whatever the heck that means. Smart traders, successful traders, focus on what's happening to their account, the P&L of their account. They derive their stops and their position sizing based on account size and then a set amount of risk. All right? They're not out looking for a home run on a single trade. They're not opening up a trade saying, I could make 100% on this trade. What's going to be the movement in the account? All right? So I'm going to focus on account growth metrics. I'm going to focus on trends, gang. We have a dovish Federal Reserve. All right? Remember, all the headlines have got to be negative because they're all competing for your attention. They're not going to tell you everything is great because then you don't need them. Right? Good news does not require help. Bad news does. If they're the ones warning you about all these hazardous things to come, one of the things that I've noticed is that trends anymore seldom seem to be trusted. We rallied all year long in the NASDAQ, and I can probably remember 10 to 1 bearish reasons for not being long the NAS, which single-handedly cost people money. All right? If a symbol is above the 200 propulsion, treat it like it's in the bullish hemisphere. Prioritize buys. Don't prioritize shorts. Okay? So focus on trends, and they're going to be mostly up trends as long as we have a dovish Federal Reserve. We'll get to that in a moment. Focus on index sector stock alignment. So if I'm looking at index sector stock alignment in the NASDAQ, for example, here we go. If I'm looking for that in the NASDAQ, I'm going to start with XLK. I'm going to take a look at XLC. So I'm going to go from technology to communications. I'm going to go from communications to consumer discretionary. And then lastly, semiconductors. Right? So I'm going to look for that alignment. These are the cylinders of the engine called the NASDAQ. 4 cylinders. If you want to look at it that way, 3 if you don't want to include SMH. But because the Magnificent 7 does include NVIDIA, NVIDIA's got a foot not only in the XLK, but it's got a foot in the SMH as well. So you kind of throw the SMH in there. Index sector stock alignment. If I'm looking for, a symbol that a lot of folks are interested in is when is crude going to turn around? Right? So really simple. When do I start getting bullish on crude, for example? Is it now? No. Above the 200? No. Uptrend? No, but at least it's not the same downtrend it was, right? Once crude starts showing some stability, if not, dare I say, an uptrend, I can start looking at XLE. I can start looking at OIH. I can start looking at XOP. XOP will benefit from strength in the natural gas. I know it's a crazy looking chart. Such is the nature of the daily price movement ranges on here. It's a pretty hideous looking chart. But if we can break the downtrend, look at the bottom of the screen. If we can break the downtrend, hang on one sec. If we can break the downtrend, that's going to help the XOP. All right. If we can break the downtrend, look at those two rows at the bottom of the screen. And I think something's not quite right with my daily price movement ranges on NG futures. We can see they look a whole lot more normal on UNG, the ETF. Once this downtrend is broken, XOP is going to help be helped out. So index sector stock. What about the S&P? Right. Everyone wants to know, where's the S&P heading? It's still in an uptrend. What are the cylinders that have got to fire inside of this thing? XLK aside, financials and healthcare. Hard to bet against the S&P when all three of those sectors are moving up, and hard to bet against healthcare. What a November, December healthcare had after pretty much suffering, languishing, lagging all year long compared to the other strong sectors in the NASDAQ and the S&P. It finally in December crossed over not just the 200, but it went positive on the year. Not by much, but it did go positive on the year. And gang, this kind of reminds me of something that I've seen before. Many of you have seen this before, and that brings us to our playbook for 2024. I'm going to track the expectations for rate cuts on the Fed Fund futures. The CMA Fed Watch tool is fantastic for that. I'm going to keep an eye on bonds. I want to see bond yields continue to drop as the ZB is in an uptrend, as the ZB is also crossing the 200. It's just, it's had a tough year. Hasn't kept the equity markets from rallying, by the way, has it? But I would like to see two things, not just ZB continue to move higher, but also 6E. This is basically an inverse look at the US dollar. This is the euro. You want to know where the dollar is going? Look at the euro. You want to know where the euro is going? Look at the dollar. If the euro's in an uptrend, the dollar's in a downtrend. Okay? So I'll look at some of these things. These are the symbols that will help me confirm expectations for the FOMC rate cut, not to mention the target rate probabilities, and then things like bonds, notes, euro. Doves, which is what the Federal Reserve is leaning towards now, and bulls equal an uptrend. Gang, please, please, please do not listen to the same people that told you probably early 2023 that we were heading for disaster. They were wrong then, and they're likely going to be wrong now. Look, ignore the news. You'll see that's number 5 for the playbook. Ignore the news. Sell-off and bear markets have never happened when it is expected. Did we all talk about the regional bank crisis in February before it happened in March? No, it blindsided us. I know. There's some know-it-alls that saw it all along. Yeah, of course they did. But we don't get crises when we're expecting them. They don't happen that way. Okay? So, if we're talking about bearish possibility, gang, that's kind of a confirmation for an uptrend. So you wouldn't say when everyone stops talking about all the scary things at the top of the stairs, right? Under the bed. Yeah. Then we want to remember we could see pullbacks, but we cannot prepare ourselves for black swan events. I love the book. I love the idea. Who the heck can trade that? We're always waiting for calamity. That's all we ever do. We just wait for that one moment. We brace our whole year for a black swan event like KRE. I can't say how galactically stupid I think that is. When the NASDAQ, right? Am I going to prepare for a black swan here? Or am I just going to follow a trend that lasted all year long? And yeah, I know I'm a little salty on this because I hear people say, Rag, I missed the move this year. And it kills me. And I know why. Fear-mongering. Shut it out. Counter-trend trading is revenge trading with a better name. Anyone who looks at an overall uptrend and thinks these tiny moves are the trade are the same people running down the up escalator. It looks foolish because it is, right? Don't do it. So when we get into more a tactical look at the playbook, right, the wave is always going to be in play, but with less frequency than the daily price movement ranges. So it's not a matter of what's right or wrong. It's a matter of which is in play more often. Sometimes we will bounce off an anchored volume weighted average price. Not often. Sometimes we're going to bounce off the 200. Again, not often. So the frequency of occurrence is the question. If I'm looking for pullbacks to the wave, that's what that looks like. But if I want something really active, it's going to be the daily price movement range, right? So it's not a matter of right or wrong. It's just a matter of layers in terms of support within the context of uptrends and overall bullishness. And to be above the anchored VWAP, to be above the 200 propulsion, gang, these uptrends are seldom trusted. Okay, I did allude to rotation versus participation. This is really going to be what's interesting. Money can come off the sidelines. We don't have to see rotation. I'm going to show you what that would look like right now. So when I look at COIFIN and I look at the year to date and I look at the normalized performance, and I've plucked out the main sectors that are weighted in NASDAQ, S&P, Dow, Russell, sector rotation would basically be these names, which, by the way, are all NASDAQ NQ names, right? Taking profit there, while, say, these names, the ones either at the zero line, you can see right there, or below it, would benefit from those flows. Now, we can look and measure the outflows and the inflows. So these aren't surprises. These aren't things that we can't see coming. We just have to know where to look. This is going to be where to look. Sector rotation is not a random thing. It's typically, and it doesn't have to happen with these particular sectors, right? There are a lot of other industries that we can look at. I'm just looking at the main ones that would affect the way in which the broader averages are moving. Yes? Okay. So with that in mind, we don't have to see semiconductors, tech, communication, and consumer discretionary pull back dramatically. That would be rotation. Rotation is these move lower, the money flows here, these move higher, hence rotation. Yes? We can see participation, which is seldom discussed. What if we have a dovish Federal Reserve, gang? Money's about to get cheaper. Lending's about to get cheaper. This can keep going up, and this can join the party because money is coming off the sidelines, right? It doesn't have to come from the strong sectors. That's what rotation is. It can come off the sidelines. That's participation. Okay? So now we know where to look, and then we can look at the flows. And we'll talk a lot about flows and rotation as we go into the top tier outlook in January. I mean, most of what we're going to be doing the first couple of weeks, maybe probably the first 4 weeks of January, are going to be that bigger picture look of, are we seeing the signs via trend, via normalized performance, and via flows of participation or rotation? You can track it. So if that's something you've been wanting to learn how to do and watch it in real time in a big month for sector rotation, we're going to be doing that in the Sector Secrets Mastery, and that will be in the Top Tier Outlook newsletter, which I know those of you that subscribe to Top Tier Outlook will get, and of course, those of you in the Mastery get with your subscription. Okay, with your membership there. So that's a lot of what we're going to be doing. And so that's my playbook, gang. That's my playbook. And ignore the news, gang. I have seen more, the real estate market's going to crash, more, the recession is coming, headlines than I have seen in a long, long time. And it does make me salty. You might say, salty, Raghee. Yeah, it does make me salty. Because these are the same folks that kept investors and traders from being bullish all this year long. Okay? So, remember, trade what we see, not what we think, and then map everything with the data. If we follow the data, whether that be normalized performance, whether that be outflows, if we trade what we see and not what we think, we will be fine. And then remember, unless, and I don't, again, we can track this too. I don't see this happening. But unless the Federal Reserve goes, nah, just kidding, psych, which we'll see in the target rate probabilities. As long as the target rate probabilities indicate 70% and growing expectation for a rate cut in March, it forces the Federal Reserve's hand, gang. This is not just a reflection of what we think they're going to do. This is also telling them what we expect is going to happen. And you can see the current rate is 525 to 550. Come the March 20 meeting, it's expected to be a quarter point less. Come the March meeting, it's expected to be another quarter point less, gang. So we're not just looking at a March cut or a May cut. We're looking at a March cut and a May cut. That brings us out to June. So if I'm at 475 to 500 on the May 1 meeting, gang, we're another quarter point lower in June. The Federal Reserve is expected to cut rates. Do they have to follow this particular path? No. But we're getting cuts, gang. And if you've never watched a dovish pivot from a Federal Reserve before, you're in for a treat. Okay? I cannot and will not go into 2024 bearish. I am sure there's all sorts of reasons for expecting the sky to fall. Same ones that everyone talked about last year. And like a broken clock, perma bears will be right from time to time. And like history has proven, they will be wrong nearly all the time. Okay? So those big moves to the downside will come. The smart bulls just make sure they take advantage of it. And in the meanwhile, we trade what we see, not what we think. Daily price movement ranges and 34 EMA waves within the context of the trend are absolutely what I want to put to work. This is going to be a super trend kind of year, gang. I have no idea where we're going to go. I'm not saying it's going to be just up and away. What I'm saying is when we have the macroeconomic factor, single factor of the Fed cutting rates, it's hard to be a bear. Now, we still will use all those other, go back to my New Year's resolutions. I still got to focus on the trends and I still got to focus on index sector stock, which means this is not just buy everything indiscriminately at higher highs. That is find the trends, wait for the dips, right? Rinse and repeat. I hope that makes sense, gang. And I hope that's a thorough look at exactly what we're going to be doing again in 2024, only this time with a lot of wind at our back. I'm looking forward to it. I cannot wait. It's been a while since we've had a dovish pivot like this that we can take advantage of, one that's been really well projected as well. And all the signals, all the confirmation is there. It's really going to be traders who are willing just to push the negative news aside, because it's always going to be there, and focus on what they see. Index sector stock alignment should light the way.